Welcome back to another round of videos on research on corporate transparency. So we are now at Unit 5. We're talking about disclosure channels, and this is the first element, and it's more of almost a introductory element talking about disclosure processing costs. So the term disclosure processing costs directly relates to the overview article by Blankenspor et al. That has been published in the Journal of Accounting and Economics in 2020. This is a really nice article, which has a lot of information. So I really encourage everybody to take a good look. By the way, all the literature that I'm talking about is on the slide deck towards the end, last slide, so that you can do all the reading. Okay, so this paper introduces the notion of disclosure processing costs, or it uses the notion of disclosure processing costs, which was of course used in prior literature as well. And it breaks it into three conceptual components. So this is awareness costs, acquisition costs, and integration costs. Taken together, you can understand disclosure processing costs as the cost to actually use the information that is being disclosed by a firm. Okay, so when you think about our disclosure theory units, then most of the time we were very silent about this. So we either thought that maybe disclosure is costless to use, as in basic unraveling models, or we were just saying, there might be some cost attached to disclosure, and this cost could be the cost of producing this disclosure or the cost of using this disclosure. And this led, for example, in a typical unraveling setting to some pooling equilibrium with no disclosure, because the cost outweighs the benefits of disclosure. So you can understand the whole discussion of disclosure channels as breaking up this notion and trying to deliberately study the effect of disclosure cost. And when we talk about disclosure cost here, we are talking about the disclosure cost that materializes with the receiver of the information. So most of the time, the investor. So Blankenspor et al., the review article, has a very equity market centered view, and this is perfectly fine. This is what they chose to write their report on. But most of what we discuss here can also be understood on conceptual grounds for other stakeholders. So, for example, debt market participants, or maybe customers, employees, or whatever, whoever uses disclosure, right? And whoever uses disclosure needs to understand this disclosure. And here, I think these three different levels come in very handy. So awareness costs are the costs that are related to actually becoming aware that this information exists. Yeah. So when you think about your studies in undergrads, when you did your accounting classes, then you can think about this as an investment, so that you can actually become aware that something like accounting information actually exists, right? And now when you think about sustainability information that is a little bit less standardized than financial accounting information, you have to actually search and dig on the web for information on the sustainability of firms. And this is also, you can consider this to be awareness costs. So the costs that you actually, that you need to become aware that this information actually exists. Now, acquisition costs is the next level. So once you become aware that this information exists in general, you still have to acquire it, meaning that you have to obtain it, that you have to process it to a level so that it becomes information for you. Yeah, that might require, using some processing, some algorithmic processing, like a natural language processing, or some other means to actually distill the information from, let's say, the signal, right? Sometimes this is easy, sometimes this is very straightforward, sometimes this is hard, because information can be very complex. So now, once you have this information, still it needs to affect your decision making, and for this you need to integrate this information with the information that you already have. These are integration costs, and sometimes, again, they can be relatively trivial, sometimes they can be really hard. So think, for example, you're a financial analyst. We will have a full element on financial analysts coming up. But think you are a financial analyst and you have your valuation model, but you also want now to introduce additional alternative information, maybe satellite data about parking lots, to say something fancy. And now the additional information will affect your valuation of a firm, but you have to figure out how exactly it does that. And that could be relatively costly, right? So this again would be another level of costs, and that would be integration costs. Okay, so now that we have understood what these different disclosure processing costs components are, here the rest of this small element will be about what has been done in theory on these disclosure processing costs. So first we look at the rational models, and I'll be very brief here because each and every model would of course deserve a whole unit or a whole element at least. So I will be basically throwing references at you here, and I apologize. So the first model right? Because we talked about Grossman and Stieglitz in the last unit extensively, or at least a little bit. And so Grossman and Stieglitz, as you know, study information and disclosure cost in a setting where all traders are perfectly competitive, so they're all equal. They have the same endowment in terms of what they start with, and then they compete over information acquisition. And that Grossman and Stieglitz have no equilibrium where all the information is being obtained. And this is a standard outcome of these type of rational equilibrium models. So this has motivated people to design models where there is imperfect competition for information, because the different traders have different information endowments, so they are heterogeneous, and they cannot compete with each other in a perfect market because of this different endowment. And the seminal model there is the Keil model, and I feel a little bit bad because we don't talk more about the Keil model because it's so interesting and also so important. So I really encourage you to spend some time with it and read the paper and think about it, because the Keil model is really at the heart of the market microstructure literature. So it explains how, in a setting where you have traders with heterogeneous information endowment, how they will trade on this market, and how they will exchange information via the price mechanism. In the Keil model, you also have an equilibrium which is not fully revealing, but the interesting thing is that in the Keil model, the traders learn from each other via the market mechanism. And this is really fascinating to see. They will obtain information. This information will partly be transferred via the price mechanism, and I think this is a very insightful model. Okay, so Grossman and Stieglitz and Keil both are essentially single asset models, and so one risky asset, one risk-free asset. And of course, in reality, we live in a multiple asset world. So there have been extensions which use in these rational expectations equilibrium models for multiple assets, and one of the seminal papers there is Admati in Econometrica 85, and Admati shows how information is heterogeneously distributed across multiple assets gives rise to another partly revealing equilibrium where some information is being revealed via the price mechanism, some isn't, and again here traders decide on their information acquisition, and the cost is in the center of the analysis, so this is why it belongs here. So now there's another class of models that now explicitly seeks to study why it can be rational not to use all information that is out there, even if it is relatively low cost. And these models, they are called rational inattention because they explain why agents actually decide not to use information, although they are rational. And there's a seminal paper by Kaspersky, Van Nieuwenkamp, and Feldkamp in Econometrica 2016 that studies this behavior in front of the background of the mutual fund industry. So they look at the mutual fund industry and they ask this question: well, how does this work? How does in the mutual fund industry, how do they allocate the assets to certain portfolios? And so this is an interesting paper because it makes an argument that these fund managers, that they rationally decide to focus on certain firms along the life cycle of the business life cycle of these firms, right? So they focus their attention, given that they have limited capacity to actually use the information that is out there. They rationally focus their attention along the life cycle of firms, and this then generates these portfolio decisions. And the interesting feature here is that the information cost is a little bit different. The information cost is not that much directly related to acquiring the information, but simply because the overall capacity that a trader has is limited. So the trader cannot simply has not enough time to digest all information and has to rationally decide to allocate their attention to certain firms and stocks. Okay, so I like this notion because I personally sense that this is relatively close to what the real life situation is, right? So you have, as a professional investor, you are aware that there's a lot of information out there, and in principle you also have the means and the infrastructure to actually acquire and process this information. So it's not that it's such too costly for you to, let's say, seek information on a given stock, but taken together, the overall magnitude of the information is such that you don't have enough capacity to process all of the information. So you have to pick, you have to decide, and you will try to do this in a rational way. And I think it's interesting that these rational inattention models can actually predict behavior that is relatively close to real life in this regard, so that the managers, as fund managers, are rationally inattent to new information. Okay, so now all these rational models, they do a reasonably good job to actually describe market behavior, but there are some issues that are extremely hard to reconcile with rational models, and this has given rise to the whole behavioral finance literature. So there is enough evidence, I'd say, so that market participants behave in a way that is really hard to reconcile with rational behavior. And one classical example is Delavinga and Pollet, that they look at the trading activity over weekdays, and they see that there's a Friday anomaly, and this Friday anomaly is simply related to limited attention. And this is really hard. This is really hard to reconcile with rational models, I think. So and they used the psychological literature and psychological biases to understand why certain trading behaviors are manifested in the market. So, and as I said, Delavinga and Pollet, this Friday anomaly is a classic. Barber and Odean. So Barber and Odean have a set of papers that speak to individual trading behavior in a behavioral finance setting, and so one classic is this All That Glitters paper, Review of Financial Studies, 2008. By the way, Barber and Odean, they really have fancy, catchy titles, and of course this is a bold move, but at the same time it also helps people to memorize your paper, so that can be helpful. So in this case, All That Glitters, the title is a little bit longer, but they look into stocks that grab attention because, for example, they have very high stock returns, or they have extreme earnings, or high volatility. Everything that grabs the attention of investors, and they show that retail investors normally overinvest in these type of stocks. And they argue, and this makes intuitive sense, that retail investors have just not enough processing capacity to look at the whole market and to understand the whole market, and this is why they have to focus on stocks that they actually get aware that they exist. So acquisition costs again, right? So, or excuse me, or awareness costs in that regard. So they say that this is more related to buying behavior, because selling behavior for retail investors is not that complicated, given that they can only sell stocks that they own. Yeah? So retailers don't go short. So and of course it's much easier to be aware of the stocks that you own than being aware of the stocks that you don't own, right? So, and this is the classic argument of limited attention in Barber-Odean. So then there's another thing that is interesting, and that's related to attention and overconfidence. There's a theory paper, Peng and Shuang, in Journal of Financial Economics. Really interesting stuff that looks into the question how investors that have attention bias can actually allocate their time, and they argue that these traders or investors are more likely to focus on market-wide and industry-wide news, because this is easier to process. It's also it's not as heterogeneous, not that many pieces of information, and this is similar to the rational attention literature, I think. But in principle, Peng and Zhang make this argument simply with the attention bias, and they show that this type of behavior causes this covariance of returns to be stronger because everybody trades essentially on the same information, and this fits some empirical phenomena in asset pricing reasonably well. Yeah. So, and then there's Barr-Bernardin again. Yeah. So using I think similar data than in the other paper. In the QJE article 2001 with the nice title "Boys Will Be Boys: Overconfidence and Overinvestment" or something like this, they show that there is a gender misbalance in investing properties, and that men actually tend to hold too many individual stocks and also trade too often compared to females, and they see this as evidence that males are simply overconfident. We know this from the psychological literature that men tend to be overconfident relative to women, and that they link this to the actual trading behavior. And then there is Barbaros Shleifner-Vishny in the Journal of Financial Economics, yet another interesting paper that looks into two phenomena that sound a little bit contradictory, but in combination describe individual investment behavior reasonably well. The first is conservatism, meaning that investors are generally reluctant to change. So then they keep sticking with their portfolio because these decisions they make them uncomfortable, right? So taking decisions is hard and stressful, and you would rather avoid it. So this is the first bit, and the second bit is then when they start to trade on information, they believe the information to be more representative than it actually is. So they think that now there's a positive earnings news for a firm. This will go on in the future. So this is likely to be true also in the future, and then they tend to take these signals as being representative for something larger than the signals actually are. And this taken together explains reasonably well a lot of the trading behavior or trading biases that we observe in the market. So obviously this is just a quick glance at the behavioral literature. There are many more papers. I would also encourage you to again take a look at the fine Blankensport et al. Review paper in Journal of Accounting Economics, because it does a good job in summarizing some more of the literature. But I wanted to start this unit off with this more conceptual element, so that you see that A, disclosure processing cost is something that can be understood in these three components, and B, that there again is a theoretical literature that helps us to understand how disclosure processing costs actually shape behavior. So that the fact that this is there will change the way that markets work, and you see that you can see this from a rational perspective, yeah. So and you can see this from a behavioral perspective. But the takeaway from both theoretical model classes, if you want, is very similar. So disclosure processing costs matter. Yeah, they will have an effect on asset prices and markets. And this is what I want you to take away from this unit, right? So disclosure acquisition costs are really relevant. And since they are really relevant, I think it's also important that we think about how different disclosure channels actually work in detail, and how these channels actually affect disclosure processing costs. And this is essentially what the next elements of this unit are about, right? And we're going to start with the financial reporting environment, including the actual reporting regimes by regulators and data aggregators. Okay, and then we will move over to financial analysts, and we will end with the media, both traditional and social. Okay, cool. See you in a bit. Cheers, bye.